Welcome to Larking Gowen Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hello, welcome. I'm Dominic Carter, tax partner at Larking Gowen, and I'm speaking to my colleague, Gillian McGill, VAT director. We'll be talking about tax and property acquisitions. And Gilly, on that theme, we've had a number of conversations about situations recently involving VAT on property acquisitions, and some interesting themes coming out of those. What are your top tips for anyone who's thinking about acquiring a property and the VAT issues that might arise from that?
Okay, so the very first thing to make sure you understand is whether what you're buying is actually property or is in fact a property business. And this can come unstuck at the last minute if you don't actually think about that question until you get to the point of putting pen to paper and signing the contracts. The reason it matters from a VAT perspective anyway, but also from a legal drafting perspective, is that if what you're buying is actually a business, then the entire legal contract needs to be different, and also the VAT treatment can be different. And instead of having to pay VAT, you might find that the purchase is outside the scope of VAT, being what's called the transfer of a business as a going concern, or a TOGC. Now, where we see this with properties is not so much the obvious scenarios where you've got a building with some stock and what you're buying is the building, its stock and perhaps its employees. That's obviously buying a business, not a property. But more commonly where you're buying the freehold of a building and perhaps all of the building, or maybe just part of it, one floor, is being let out to a tenant. And when you buy that property, you will also be getting the benefit of that tenancy agreement. And in that scenario, you will be purchasing a business, and we will be looking to get you outside the scope of VAT as a TOGC. So that's the first step. What are you actually buying?
So that's really important to understand what the subject matter of the transaction is, isn't it? And as you say, that sounds like it should be identified at a really early point in the process.
Yeah, once you know you're buying a property and not a business, the next probably obvious question is, what sort of property are you buying? Are you buying a commercial property or a residential property? And again, those have two very different treatments for VAT purposes, so we need to understand that early on, preferably. What looks and feels like it might be a residential property to the man on the street won't necessarily meet the very specific VAT definition of what qualifies as a residential property. So if you're speaking to us, we will be asking you some what seems like spurious questions about the nature of that property in order to understand whether it does in fact meet the VAT definition of being residential or not. If it does meet the definition of being a residential property, then you shouldn't be paying VAT when you purchase it. And that's really, really important, because if you pay VAT that has been charged to you incorrectly, you cannot recover that VAT. So it's going to uplift the cost by 20% for you incorrectly. So we need to understand that again really early doors.
That sounds crucially important, Gilly. It's a really large chunk of the price, isn't it? And it sounds like you've got to be absolutely clear that if you do end up paying VAT, that is VAT that you can recover.
Yeah.
Equally, whilst we're not dealing with this, if you're in the seller's position, it's probably the opposite, isn't it? And you would want to make sure that you're applying the correct VAT position.
Yeah, definitely. So then if we're buying a commercial property, which is probably 75% of what you and I deal with, you'll need to know whether it's a new commercial property, that's one that is less than 3 years old, or whether it has been opted to tax. If it's a new property or it has been opted to tax, then you can expect to pay VAT on that purchase. If it's not new, so it's more than 3 years old, and it has not been opted to tax, then the property will be VAT exempt and you should not be paying VAT to the seller. And again, that's important for knowing whether you can then potentially recover that VAT if it's been correctly charged to you or not.
So that's really helpful. It's a question of understanding what it is that you're buying, and then the question of the nature of that property, commercial or residential, and whether it should carry VAT.
Yeah, and I mean, the additional thing to be thinking about here is for many of the businesses that we speak to who are buying properties and incurring VAT, they will then be able to recover that VAT. And I mean, that all comes down to what they plan to do with the property, but in the majority of cases, they'll then be able to recover that VAT. So it's nothing more than a cash flow issue that needs to be identified and managed. But of course, if there's VAT on the property, that will uplift the value to which stamp duty land tax gets applied, doesn't it, Dominic? And that's your field of expertise, or one of your fields of expertise.
It is, yes. The stamp duty land tax position has become increasingly complicated over the years, with a proliferation of different rates, all seemingly higher than the ones that previously existed. I do still remember the days when stamp duty applied to property acquisitions, and then, of course, since 2003, we've had SDLT as a new tax, at higher rates than stamp duty was charged, and then gradually those rates ramping up, particularly in relation to residential property. But as you say, also, very important on commercial property, that's still a 5% top rate on that. And as you say, when we're talking about the commercial situations, an acquisition of property with VAT charged on it, even to a business which is able to recover the VAT, will increase the amount of SDLT payable because, as you say, that is charged on the VAT inclusive price.
And that still comes as a surprise to a number of the clients that we speak to. So it's worth emphasising that point. And am I right in thinking, Dominic, that there are going to be some stamp duty land tax changes in April 2025 that we need to be aware of?
There are, and there have been. We had changes from the budget date. We also have changes from the 1st of April. If I start with the 1st of April first, the rates of SDLT have been reduced on residential property for the last couple of years, which was always a temporary reduction, but it always comes as a big hit when those temporary windows come to an end. Often there's an expectation they will be extended. But I would imagine that residential conveyancers are pretty busy at the moment trying to get transactions through ahead of that 1st of April increase. We've also got a tax that's a little bit like SDLT, is the annual tax on enveloped dwellings as well, which is basically a tax on companies who hold properties and are subject to, residential properties, and are subject to an annual charge based on the value of those properties as well. And 1st of April is the date, the start of the reporting period for 2025 to 26. And with that, there's an annual uplift in the amount of the ATED charge for companies for the coming year. So those are the changes that are forthcoming. We had some significant changes in the budget as well last year. So we talk about VAT being a 20% tax on transactions potentially, and the vital importance of making sure that it can be recovered where it is charged, where we're acting for the purchaser. But for SDLT purposes, those rates on residential property at least have really got up as well. So now we actually have a maximum rate of 19% for SDLT. It's probably quite a convoluted way that you would end up paying that amount, but it's very real in practice. So in the budget last year, there is a special rate of previously 15%, which applies to the whole of the price paid for expensive residential property. Expensive in this case just means £500,000 plus. So
not terribly expensive.
That's a threshold that
really
has not moved since it was introduced. So not really expensive residential property, but where you own, where an acquisition of that type of property is made through a company and there isn't a relief which applies, then there used to be a flat rate of 15%. That was uplifted to 17% in last year's budget. And the way I get to the 19% is if you are a non-resident purchaser, there is a 2% non-resident purchaser surcharge.
Okay.
So to that type of a purchaser, on that type of a property, acquired through a company, there is a potential 19% SDLT rate. But all of the rates have increased significantly over the years.
And SDLT is just a cost. There's nothing you can do about it. There's no way to recover it. It's
there is no recovery of SDLT. So the aim is to minimise that in any legitimate way that you can. There are exemptions and reliefs. Talking about the flat rate of 17% on high value residential property acquired through a corporate. There are a number of reliefs that apply to that, reflecting genuine bona fide property business and property trading activities. So if you fall within one of those, in principle, that's not a rate that you'd have to pay, but you'd still have to pay the normal rates that are applicable to residential property. And bear in mind that for a number of years now, for second homes and all residential properties purchased through companies, there is a surcharge that applies to that on top of the normal rates. Again, that was 3%, but that was uplifted to 5% from budget day last year. So again, the rates are still high, albeit they're not as eye-watering as where you would get to with the very large flat rates. So it is a huge cost, and it is, as you say, an irrecoverable cost. And when you're looking at things like exemptions and reliefs that are available, very important to explore that, make sure that you qualify for them, and make sure that you don't do anything that causes you to fail them. And again, if I pick on that very high flat rate of SDLT, often people think they'll acquire residential property through a company. It's strictly for business purposes. They're going to potentially rent that property out on a fully commercial basis. Well, there's a rule there that says if you have any occupation from the a non-qualifying individual, so basically somebody connected with the company, then that will prevent you claiming the relief. So often, and we've seen this in case law, we've had situations where properties have been occupied on a very transient basis for a variety of reasons, not really with a view to enjoying living in the property, and that has prevented relief. So that's massively escalated the SDLT cost that would have been paid compared to somebody having taken the right steps to ensure that they were squarely within the reliefs. So the best advice on that is to take advice, make sure you know what you're doing and how long you've got to do it for, because there is a 3-year clawback period as well. So that's just one example, but crucial importance of mitigating your SDLT liabilities wherever possible.
Well, sounds terribly complicated, and I think it's vitally important to emphasise that property transactions are high value and therefore the tax at stake, whether that's SDLT, VAT, whatever tax it might be at stake, is normally also a high value, and it really is worth taking advice before completing on any property purchase or indeed sale, if that's what you're contemplating.
And we're looking at two taxes there that are transaction related taxes, aren't they? So there's nothing you can do. If you get things wrong at the time of the transaction, you are going to be stuck with that. So, plan, take advice, make sure you know what you're doing. Shall we talk about some other property taxes, Julie?
Yeah, what have you got in mind?
Well, I mentioned the annual tax on envelope dwellings, or ATED. That's one that has been there for a number of years as well. It's a little bit like that flat rate of SDLT, except that it applies annually rather than as a one-off on purchase.
So is it intended as a disincentive for holding properties in that way, do you think?
It absolutely is, and this is a recurring theme, and I know we're not talking about and don't advise on council tax, but there's been some developments on council tax around councils discouraging second home ownership, hasn't they? So many of the tax rules around property are intended to incentivize particular behaviours. Second homeowners seem to be public enemy number one at the moment, don't they? And have a degree of sympathy with why that is in some cases, albeit appreciation that second home may be a rental home or what have you. So the annual tax on envelope dwellings was introduced at the same time as the flat rate SDLT charge in 2013, and that was specifically with a view to targeting situations where you had people come in and buy up really quite high-end London property, in principle, often with a view not to living in it, not to putting it to any use, but typically the sort of super wealthy acquiring properties that just take property out of normal usage.
So just holding them as an investment to appreciate.
Holding as an investment, or potentially a property that they use very occasionally on visits to London or the UK, and the rest of the time they're not occupying it. It's not available for rent. It's not being used for any other purpose. So those measures came in, in 2013 with a view to trying to disincentivize people from doing that, or if they do it, applying a large SDLT cost on acquisition and a large ATED charge each year thereafter. So, as I say, those rates have gone up, albeit only in line with inflation, and you're looking at, for a property from £500,000 to £1 million, 4,450 as an annual charge.
Wow.
Annually. Not necessarily a huge amount, although your wow reaction suggests you think that's quite a significant amount.
It's a lot of money to pay for effectively nothing, isn't it?
It is. If we move up to the 1 million to 2 million barrier or band, £9,150 is how much you will pay in 2025-26 if you hold one of these properties through a company. And probably the highest band that I've seen in practice is the 2 million to 5 million, and that really jumps up to £31,090. So, and there are bands above that. There's a 5 to 10 and 10 to 20 and a 20 and above, and they're into the six-figure numbers, how much you would pay on an annual basis. So that is a substantial charge, and particularly at the higher levels, and a recurring one each year. So if you were thinking about acquiring residential property through a company, you would definitely need to think about SDLT and the sort of rates that would apply, whether they're on the flat rate basis or otherwise. You would have to think about the annual tax on envelope dwellings and how much that was going to cost you. I'm assuming you're occupying the property or doing something with it that causes it not to qualify. So other things you'd need to think about would be benefit in kind charge if you were occupying the property. So those charges can be quite substantial. Really quite a number of things that you would have to really carefully think about. And I know I've sort of discussed these issues with clients, often in the context of we have surplus profits in our company. We may wish to do something with them. We might want to invest in rental property, for example, and there might be some non-qualifying use as well. And by the time you add together all of these potential tax charges, they really are quite substantial, and it's quite a deterrent really from doing that, unless you really are intending to do it purely from the point of view of using that property for the purposes of business, or if it's a rental property business, it genuinely is third party unconnected rental. So lots there in terms of residential property. I guess another thing that we often are asked is that question of corporate or individual ownership.
So the ATED you mentioned is only relevant where you've got a corporate holding residential property.
That is absolutely right. So all of the things that I've just mentioned, really, the flat rate of SDLT, the ATED charges, benefits in kind, all of those things are if you're using a corporate to make the acquisition. If you're acquiring personally, they won't apply, but there are obviously other things to consider. So, for example, you might be aware that another one of those measures to discourage second home ownership, which came in a few years after those measures that I talked about, is the restriction on income tax relief for mortgage interest. And that really came in for a similar reason, and that is now restricted to being able to obtain relief for that at the basic rate of income tax. So that's something factor that some people think pushes you the other way, that if you are a property landlord, or you're going to invest surplus business profits to acquire a property which you would hold as an investment, that might actually push you to doing that within a company on the basis that there's no interest restriction to a company. That's only half the picture, though, because you've then got to think about things like, well, that applies to corporation tax at 25%, so, or perhaps 19%. So you have to think about how rental income from that property is going to be taxed if it's held individually or if it's held in a company. So income tax at rates of up to 45% compared to 25% corporate tax rate on your property business profits. Then you want to think about capital gains if you disposed of it. So 24% rate of CGT for you as an individual, but of course you've got proceeds in your own hands, or 19% or probably 25% in a company, but the proceeds are still there in the company.
And then you have to get them out somehow.
Exactly. So you'd have to take a dividend, for example, and then there's tax on that as well. So there are a whole range of factors to consider, some of which would push you to individual ownership, some of which would take you to owning through a company. And it really is back to a similar question to the one that you answered at the beginning of our conversation, Gilly, which is understand what it is you're buying, what you're buying it for, then work out what the tax treatment is and work out what the best vehicle is for that to be owned.
So advice definitely needs to be taken.
Absolutely.
And it will be bespoke to every person's circumstances, most likely, and potentially for each property or property type acquisition that you're looking at too. So
it will. I mean, I think we spend most of our time acting for owner-managed businesses. We do deal with other businesses and organisations, some large corporates, some not-for-profit entities, for example, but the bread and butter of what we do is advice to owner-managers and their businesses. So we find there's an immense amount of complexity around property taxation, and generally 9 times out of 10 we are not dealing with complex or esoteric situations. We're dealing with the everyday, and for there to be this much complexity in the system and this much potential cost is really quite remarkable.
Yeah, and speaks somewhat to the the abolishment of the Office for Tax Simplification not having been the best decision.
No, it is an incredibly complicated situation. But it could be a lot worse. Overseas governments do sometimes apply, or consider applying really draconian charges. So I think I've heard recently Spain is looking at a 200% tax for non-EU nationals acquiring property in Spain. So we've probably got the worst system until you think about all the others that are out there, haven't we?
The least bad.
The least bad. Well, I think we discussed some really interesting, in my book anyway, subjects in this conversation, Julie. Thank you, anyone, for listening. If you're still here, hope you enjoyed it as much as we did. If there is anything that you would like to ask us or any further information needed, details are provided in the show notes.
Thank you.
Thanks very much, Julie.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.